I'm Charlotte McLeod with the Investing News Network, and here today with me is Lobo Tigre, editor and founder of IndependentSpeculator.com. Thank you so much for joining me once again. Great to see you in person.
Indeed, I'm happy to be with you.
Yes, and we've got a lot to talk about today, and where I want to start is with uranium, because we had earlier this week, I believe, the big news from Cameco. So they're going to team up with Brookfield Renewable Partners to acquire Westinghouse Electric. That sounds like a big deal to me. I haven't had a chance to talk to anybody about it yet, so I wanted to get your take. What does this mean for the sector?
Well, I want to be careful here because I try not to give away free stock evaluations. I don't want to give stock tips, but this is big news. You know, when Cameco does something, or Kazatomprom, right? It's quite significant and it's meaningful for the market. I haven't evaluated the deal itself yet. I haven't dug into the math and so on. There is a financing involved, so it has hurt the stock on that. But conceptually, I like it. There is for a big company like that to get some vertical integration, it gives it access to a kind of stability. Right? If you're just a miner, well, Cameco has other things going on too, Silex, other things. But if you're mainly just a miner and the spot price goes up and down, that's going to affect your share price more. But if you're part of a bigger business, then that adds some stability there. So conceptually, I think it's interesting. What does it mean for the industry as a whole? It's not terribly impactful, but I think it is positive there too, because I don't think, Westinghouse the way it was, they weren't on a mission from God, to quote the Blues Brothers, to really make things happen in this space, whereas Cameco is. And I do think that should be good. It should help the industry. And then it just gets, and I haven't done this yet, it gets down to, brass tacks, looking into the deal. What are the metrics here? Is this value accretive or not? And I haven't done that yet.
Yeah, I mean, it's been a busy week for sure. So, and what I was wondering really was more, you mentioned the vertical integration. I was interested in that. And I was also curious as to whether you think this will affect the way we see M&A activity move forward in the uranium sector.
Probably not. I don't think there's a lot like this out there available.
Yeah.
Whereas, not stock tips, but look at the UEC deal. And that's the second. They just gobbled up UEX, and now they're getting Rough Rider from Rio Tinto. So there's a lot of activity here. We've been looking actually for more M&A in the mining sector writ large. There was such a dearth during the COVID shutdowns, you couldn't travel for due diligence. And we've all been sort of waiting for that M&A to ramp back up again. And it seems like the uranium sector is leading the charge there. So yeah, I don't see the Cameco thing changing that. I think it's something that's likely to happen anyway. Mm-hmm. The caution here would just be size isn't everything. If you start aggregating and you become a land bank, does that really argue for why your stock should do particularly well in the near term in the cycle? So one size doesn't fit all. Buyer beware.
Okay, yes, and surely don't mean to make you talk about the specific companies, but that UEC transaction also this week was on my mind as well. So glad we talked about that.
It's notable for the industry. So
yeah,
it's
for sure.
Fair game.
Okay, and so for uranium, I'm finding it ever more difficult, I think, to pick out pieces of news to talk about because there are so many. We talked about this recently. We spoke at the end of July, I think was our last conversation. In those months, what would you highlight for people to pick out and say, like, this is
okay? A couple things. One is we're starting to see the long-term contracts. Like Rick's thing has always been Japanese restarts. Right? We're seeing that too, but that was a while ago. My big thing has always been the long-term contracts, because over the longer term, spot does follow long-term prices, which makes sense, and we're starting to see that. Another company just announced hedging really a small part of their forthcoming production on a project they're building at $50+ a pound. Not a very high price, but higher than spot. And I think that's the sort of thing that's gonna move this market. So watch that space. And we've all been waiting for this too. Like these utilities, they haven't signed any new long-term contracts for a long time. They need stable supply. When is this gonna happen? I think it's very significant that it's starting to happen now. Others have announced contracts but not prices. The point is that it's starting to happen, and I do think the long-term contracts are very important for the space. The other thing is that A, uranium is having a good year, and B, for all the market volatility that we've been seeing lately, it's been waffling along, plus or minus $50 for a while. That's actually a great outperformance. It's, look at what else is happening. Look at the other yellow metal. Gold is down for the year and uranium is up. So actually, the uranium space is doing great. It's doing wonders for my portfolio. I would be in a world of hurt if not for my uranium stocks this year. So keep that in mind. Like, the mood right now in the resource sector is pretty negative, but the uranium spot is a bright spot. And the other last bit of news would be, we talked about Kazatomprom, and they are increasing their production finally. And this, sounds bad, but they had decreased their production 20%, and now, not immediately, by 2024, they're talking about increasing it, but only half of what they cut. So they're going to increase 10%. So their production, even in 2024, is still going to be below what it was before. So I actually see this as a positive development, because people were worried, well, yeah, Kazatomprom, it's voluntary supply constraint. What if they open the floodgates again? So what we now have is guidance from the world's largest and lowest cost uranium producer that they're not opening the floodgates. Yes, prices are up, they're going to produce a bit more, but not as much as they were before. I think that's very positive.
Okay, so thank you for going through those ones. I think that helps us to sort out what's going on amid really quite a lot of news flow. We have to, I think, let you always give your caveat when it comes to uranium, which is that, you like it, but this could blow up on us, literally as you usually
yes,
tell us.
I always say.
So,
sorry, let me just jump in on that. Here at the conference, one of the slides in my presentation was, I love uranium, but, as you said, and I had a big picture of a mushroom cloud.
It was very dramatic.
I was trying to make a point, and it may seem melodramatic, but there is literally a war happening around Europe's largest nuclear power plant right now. Something bad could happen. And I'm not saying, therefore, stay out of uranium. I'm just saying, nobody goes broke taking profits. In a world in which you can wake up tomorrow and your stocks could have stepped off a 50% cliff, uranium stocks, on the wrong news, right? It makes no sense to leave all your money fully exposed. So when you have profits, take a bit of money off the table, please.
So I had a thought about that, and obviously we don't want to see another nuclear accident really of any kind. But so that would be bad for the sector. Do you think though the Fukushima recovery took a very long time, as people know if they've been following along? If we were to have something like that happen, would we have a faster recovery because we simply need the energy?
Yes. But let me elaborate a little bit. I think also it's different because since the Fukushima problem happened after the tsunami, and really the problem was the tsunami, not nuclear energy, I think. But people could still say, well, it should have been designed better. Like, these plants are built on the ocean, should have been tsunami proof. Maybe there was a short-sighted design issue there. Again, it's not inherent in nuclear energy. It's how those particular plants were built. But still, I can understand why people were like, oh, this shouldn't have happened. Whereas if it's a war, it's a war. It's not the same kind of thing. There's no design that you can come up with for anything that's war-proof. So I do think it would be different. I don't think people would react in the same way. That would be bad. I'm not saying there won't be a reaction. If there's a huge leak from Zaporizhzhia, our stocks will get clobbered. I don't think it'll affect the spot price that much, and I don't think it will affect the long-term contract price at all. Is China going to stop building nuclear power plants because of a war in Europe? No. The BRICS countries? No. I don't think it really affects demand almost at all, not in any meaningful way. But it absolutely would affect our stocks. So, yeah.
Okay, that's good. That helps a lot. So on the energy side of things, but moving a little bit away from uranium, you always give us a dose of reality when we talk, and that was one of the themes also in your presentation yesterday. So where I thought we might need that is this energy crisis coming up in Europe. We hear a lot of dire things about what this winter may bring. I wondered if you could talk a little bit about that and break it down for us. How concerned should we be? What's going on there, really?
Well, I don't have a crystal ball
No,
that
of
sees the
course not.
future, so
But
what's coming? But it's pretty clear it's going to be bad. Like there's no scenario where everybody is happy hunky dory, and energy prices in Europe were already expensive. And then you had the maintenance issues with the nuclear energy in France, and then you've got, the dried rivers, which prevented coal transportation, and you've got the pipelines. Nord Stream 2 wasn't producing anyway. Nord Stream 1 wasn't delivering anyway. But now they're blown up, right? So there's like no possible rescue there, even if the war suddenly did end. So it's going to be bad. I don't see a way around that. Implications are inflationary. I think it means that whatever the ECB does, if they do more jumbo rate hikes, it's not going to bring inflation down. I mean, long and variable lags, as they say, right? That's not going to happen on time to save Europe for this winter. So I go a little bit sideways with your question here, but I think this is useful. I think there's a very good chance that the Fed they're saying by the end of this year they should be done with their initial tightening. That doesn't mean they're going to pivot to easier policy, but we're looking for a pause, right, to see what they have done already, how it will affect the economy. That's supposed to be happening in Q1 next year. If Europe going into the winter is looking at still double-digit high inflation, got 10% in Europe, new 10% print out of Germany, and because of the energy situation that keeps going this winter, then you could have the Fed pausing while the ECB is still tightening. That would reverse the dollar milkshake mechanism. And that would be good for alternatives to the dollar, particularly including gold and silver. So in a crazy through the looking glass world that we live in, oddly enough, high inflation is somehow seen as good for the currency because the central bank's going to fight it. And that could actually boost our metals investments as a result of the energy crisis this winter.
Okay, I have a couple of things I want to come back to, but first, before we do that, I don't think it's ever occurred to me to ask you about, we know you like uranium, of course, but in the energy sector, there's other things there. There's oil and gas, there's things beyond that. Are you looking at other commodities there?
Yes. Obviously, if I could have bet on LNG a year ago and benefited from that specific crunch for LNG now, that would be great. I didn't. Let me broaden it out a little bit from the specific of the moment. I find myself very persuaded by the argument that the ESG agenda has basically choked off capital flow into the oil and gas sector before we're ready to graduate from it. Right? We're burning coal now, of all things, because there's not enough energy. What a huge step backwards. And still, Biden's telling the companies pump more, but he's not helping them on the permitting and so on. And even if he did help on the permitting, the ESG agenda, nobody wants to invest in these industries. And if you're going to outlaw internal combustion engines in California or New York within 10 years, or European countries doing that, why would you build refineries, oil refineries, when oil-burning cars are going to be outlawed? Like the whole macro trend here is extremely discouraging for investment in the oil patch, and the market is responding rationally to that. But it's going to take decades to build all these electric cars, right? We can't just flip the switch overnight and go all electric. I actually mean. I've been thinking about this, and I am very persuaded that the actual drive to stop pumping is going to make oil companies that are pumping much more profitable. The prices are going to go up. The investment isn't going to be there to increase supply. So other than uranium stocks, the other stock that I bought recently was actually an oil and gas play. So yes, I am diversifying in that direction.
Well, there you go. Okay, I'm glad I asked. On the energy side as well, so I want to make sure that we mention nickel, which you brought up again in your presentation here. So nickel, we're hearing more about the green side of nickel. People are getting excited. They're grouping it in with the battery metals, although historically we think of it as a base metal. So what are your thoughts on nickel? Because I know that they're not really entirely positive.
Yeah, well, let me be clear here. My silver bug friends call me Darth Silver because of my reality check on silver and so on, and maybe I'll be Darth Nickel now too. But I'm not actually articulating a bear case. I'm not saying that nickel prices have to go down or that it's bad investment in the nickel space. What I'm taking on is the hype. Because there's a story out there that there's this huge nickel shortage, there's not enough nickel for these batteries, we're going to run out of nickel, the world's running out of nickel. That's not true. There's lots of nickel out there. What is meant by this is that the so-called class 1 nickel that's traded on the LME, which is the preferred feedstock to go into the batteries, which is real, by the way. That's not hype. The NMC lithium-ion batteries use a lot of nickel, more nickel than lithium, actually. The C is cobalt, by the way, which is now politically incorrect. But anyway, the point is that it's just a specific kind of nickel. But nickel is a metal, it's an element. You can convert from one to the other. And, OEMs, the car makers, Tesla, is going directly to Indonesia now and contracting directly with intermediate supplies of not class 1 LME nickel. So whatever else is true, we'll see how all this balances out. There's a carbon cost to converting nickel pig iron, say, to other forms of nickel. So it may not pass the ESG test, but still, it's simply not true that you can only use this one kind of nickel. It's simply not true that there's not enough nickel. This can be very complicated. But I have a free report on the website. If you go to the website and Google, search for nickel, or it should be on the homepage, free download. We will ask for your email. We won't spam you. But give this a thought. And even if you're not particularly interested in nickel, I think looking at the market, looking at the supply and demand projections, and our thought process for how we're looking at that, I think that's instructive for all resource investors. Because if it's nickel hype now, because of the big squeeze really on the LME, there was that huge spike to $100,000 a ton, right? So everybody's talking about nickel now, but the flavor of the day is going to change. And I hope people will read this report and think about this when it's the next flavor of the day.
Okay, yeah, I would love to take a look at that. So just so I am hopefully understanding, so the class 1 nickel, you can convert other types of nickel. There may be a cost on the environmental side, but you can do it.
Yes.
So we do have the nickel available.
And sorry, one other thing. Not all the batteries have nickel in them.
That's what I was just going to say.
Oh, sorry. Okay.
No,
right.
no, and the nickel-free chemistries are a thing.
Yes, and they're taking off. So like Tesla right now is making half their cars have no nickel or cobalt. And by the way, the United States government has declared all lithium batteries to be product of child labor now because of the cobalt coming from the DRC. So the LFP batteries, they're lithium iron phosphate batteries. They have no nickel or cobalt in them. They've been held back because they haven't had the same range. They haven't had the same energy density as the nickel, manganese, cobalt ones. But that's starting to change. The newer designs are better, almost on par. Plus, if you've got the politically correct angle, the LFP batteries could become the ESG friendly ones because there's no nickel in there and there's no child labor cobalt in there. That could actually become, for woke buyers who like electric cars, that could become a very important selling point.
Yeah, I think when we first started hearing about Tesla and electric cars, people got very focused on the metals they were using at the time. And this is changing quickly, so I guess everybody's got to update their knowledge. Okay, so coming back to something else that you mentioned during this conversation, you threw out the dollar milkshake idea. And I want to ask you what you mean by that. I know it comes from elsewhere, but since you're talking about it, can you explain it for people who might not know?
Well, Brent Johnson is the originator of the dollar milkshake theory, and it's probably best to let him explain it. But just briefly, it's a way of describing the international financial system. And because of the dollar's reserve currency status and the demand for dollars under various economic scenarios, how that works. And the significance for resource investors, not just gold and silver, but commodities in large, is that the dollar milkshake mechanism describes the circumstances that make the dollar rise in foreign exchange, and therefore is bearish at that time for things that are priced in dollars, including gold and silver and other commodities. The dollar milkshake theory is not inherently anti-gold in any way. It's a mechanism. And it says, though, that when the dollar's going up, gold will go down. But it's reversible. So that's a key point. The dollar milkshake mechanism is reversible. And we saw that just last week with the UK kerfuffle. So we had proof of concept. I think that's actually very encouraging because I think the mechanism not only can reverse, but it will reverse. We were talking before about what happens this winter if the ECB is tightening more than the Fed is pausing. That should reverse the dollar milkshake mechanism. So it could be very good for long-suffering gold bugs, silver bugs, and other resource investors. Um, a key takeaway here, set aside the dollar milkshake for a moment and just look at the DXY, the dollar index. The most frequently cited is a Bloomberg dollar index. There's other ones, but the DXY is the most cited dollar index. And it has this year, particularly since the war, it has been trading inversely so directly with gold. Usually not real interest rates are the prime driver for gold, but this year it's been almost like a Rorschach mirror image between the DXY and gold. And by the dollar milkshake mechanism and the rising dollar, that's been bad for gold and other things priced in the dollar. Key takeaway here, though, is that the DXY is now at very lofty elevations. It's not at record levels, but it's at multi-decade high type levels. We've only been in these high levels really twice in the last 50 years. So the higher that goes, the more likely it is to revert to mean. And I think that's actually very encouraging. What I'm saying is, I'm not saying it can't go higher, but because it is high, the odds favor the other direction, which is good for the alternatives to the dollar.
Right. And one thing that people keep talking about is, the dollar in the context of the other currencies. So it's high because they are low. And I wondered if you could talk a little bit about that and at what point we may see others start to gain ground if we, would that be related to rate hikes around the world?
Yeah.
How does that happen?
Well, time frame matters here, and Brent's thesis is ultimately that, the dollar will continue gaining strength, that we're on a sort of death spiral here. And he thinks that ultimately the dollar, things do change, but the dollar dies on strength. It goes so high and it gets so entrenched in this high space that the rest of the world just stops functioning, and you end up with, I don't know, Bretton Woods 3 or some new accord that changes things because things stop working. That's sort of crystal ball farther in the future. I'm not really sure. I do think that the winter discussion we've had is relevant.
Yeah.
I do think that the relative strength of various fiat currencies compared to each other really has nothing to do with the price of gold. The usefulness of a real thing in the physical world, it's a different conversation from which country is debasing more. And the reality is that they're all debasing, right? So which one is ahead or debasing more? That's what we see in the DXY. That's what we see in the foreign exchange market. I think it is a mistake for these futures traders whose trades we would mistakenly refer to as the price of gold. I think it's a mistake for them to be looking at the DXY. But we're in uncharted waters. Nobody really knows what to do. Maybe that's why they're going directly there. Can't say when the inevitable becomes imminent. Can't say it's happening now yet. But I can say that, if your model is wrong, if you're looking at the wrong variable, reality does matter. And that has to correct at some point. I think the difference in the relative thing, I think that winter conversation we're having, I think that matters. I think it's very good for gold, silver, anything real priced in dollars. But beyond that, I think there's a case to be made for people sort of waking up and smelling the napalm and understanding that all fiat currencies are being debased, and therefore all real things, justifiably deserve higher prices in these debased currencies. And actually, that's kind of the way things are. Gold is down only in dollars, US dollars. It's up in everything else, and even at or near all-time highs in multiple currencies. So the world is telling you, the reality is that real things, real values, like gold as an example, they're showing us what's happening.
Okay, so I know you have a couple of interviews yourself with Brent that people could check out if they want to learn more about the dollar milkshake idea. I think we'll wrap it up there, unless you have any final reality checks that you want to give to us today.
Well, I was a bit of a rain on the parade here. And I tell people to take profits. I tell people to stay realistic. I tell people, don't stick your head in the sand about the data. That doesn't mean I'm a bear. I'm not really trying to rain on the parade. But I think people get hurt when they get too enthusiastic about any particular investment thesis, especially speculative investment theses that they just fall in love with. I think that's very dangerous. So, when I launched the Independent Speculator, I considered calling it the Rational Speculator, because I think that's what we should all strive to. But I thought that would seem a little too aloof. I get that already as it is. So I riffed on Doug Casey's International, with his blessing, by the way. I told him what I was going to do, and he said that was fine. So here we are. Be independent in your thinking, please. Don't fall for the hype. Do your own due diligence. I'm happy to help you with that if I can, but keep it real, folks.
Okay, well, thank you so much once again for joining me. Great to hear from you. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Over Tigre with IndependentSpeculator.com.